Welcome to the podcast on business cycle funds. Business cycles, as we know them today, are codified and analyzed by Arthur Burns and Wesley in the year 1946 itself in their book titled Measuring Business Cycles. But now, based upon these business cycles, our investment people created the business cycle funds. What do you mean by these business cycle funds? They are the mutual funds that invest in stocks or sectors that are likely to benefit from the recovery in the economy. Definitely, the economy of a country grows and shrinks at a distinct periods based upon the business cycle. These business cycle funds identified these investment opportunities. They evaluate stock and sectors based upon the current economic cycle and aim to invest in sectors that will prosper as a result of a change in the business cycle. In India, recently mutual fund houses have launched funds based on business cycle themes.
Let us look at how a business cycle fund typically works. We've seen the good advantages of what a business cycle fund could do. First of all, it helps in sector rotation. What fund managers typically do is they analyze economic indicators and market conditions to determine which sectors are likely to thrive in the current economic environment and then make their investment decisions accordingly. It also helps in dynamic allocation of funds, where funds maintain a flexible allocation strategy, where fund managers can adjust their holdings to overweight sectors that are expected to outperform and underweight those that may severely lag. It helps in managing risk, which helps us to reduce risk by adapting to changing economic conditions, potentially providing more stable returns compared to traditional mutual funds. And last of all, it helps us to keep our funds diversified across the sectors in order to minimize the risk and also to make our investments spread over the sectors to avoid much of a risk that can affect the returns and the profitability in the long run.
As we are experiencing this new type of fund called business cycle fund, let me explain some of the advantages of investing in business cycle fund. So the first advantage is all about diversification. As we all know how the portfolio works, so business cycle funds helps the investors to invest in the diversified portfolio category so that they can gain advantage out of the sectors when they grow. And coming to the second advantage, people may worry that how to handle this business cycle fund. So investors may think about how to handle this business cycle fund, whether it will grow or whether it will yield results. So coming to this, we have managers, fund managers who can handle this business cycle fund when the sector grows. So they know how to handle, when to invest, and how to make things happen as per the requirement of the investors. And coming to the next category of advantage is all about how these diversified sectors are growing and how these sectors are yielding a better result for the investors.
Now, let's examine the risks associated with investing in a business cycle fund. Business cycle funds, as we have seen, are mutual funds that invest in companies that are expected to perform well during certain phases of the business cycle, such as expansion or contraction. However, these funds are still subject to market risks, such as volatility, economic downturns, and changes in interest rates. Additionally, the performance of these funds may be affected by factors such as the timings of the business cycle and the fund manager's investment strategy. It is therefore important to carefully consider the risks and the potential benefits before investing in a business cycle fund or any other type of mutual fund. It is also strongly recommended to consult with a financial advisor before making any investment.
Other types of mutual funds. A business cycle fund is a type of mutual fund that invests in stocks and bonds of companies that are expected to perform well during different stages of the business cycle. These funds aim to provide investors with returns that are in line with the performance of the economy. Compared to other types of mutual funds, business cycle funds tend to be more focused on macroeconomic factors such as GDP growth, inflation, and interest rates. They also tend to have a more dynamic asset allocation strategy, meaning that the fund manager may adjust the portfolio holdings depending on the prevailing economic conditions. In contrast, other types of mutual funds may have a more specific investment objective, such as investing in a particular sector or an asset class. They may also have a more static asset allocation strategy, meaning that the portfolio holdings are less likely to change over time. Overall, a business cycle fund can be a good option for investors who want exposure to a diversified portfolio of stocks and bonds that is designed to perform well during different stages of the business cycle. However, it is important to carefully evaluate the fund's investment strategy.
How can I determine if a business cycle fund is good fit for my investment portfolio? Business cycle funds are the mutual funds that invest in the companies that are expected to perform well during specific phase of business cycle. These funds are designed to provide investors with the returns that are aligned with the prevailing economic conditions. To determine if a business cycle fund is good fit for my investment portfolio, we should consider our investment goals, risk tolerance, and investment time horizon. If you are looking for a fund that can provide returns that are aligned with the economic cycle, then business cycle funds may be good fit for you. However, it is important to note that these funds can be more volatile than any other type of mutual fund, as their performance is closely tied to the economic cycle. As such, they may not be suitable for all type of investors. Before investing in a business cycle fund, it is important to do your research and carefully evaluate the fund's investment strategy, historical performance, and the fund manager and the fees charged for it. Thank you for listening.